Good morning. I'm Vijay. Today I'm going to present a Department of Master Business Administration, a project. I'm Vijay Kumar and this is the finance accounting and the topic is generally accepted accounts. Generally accepted accounting principles. Introduction Introduction of a GAAP. GAAP stands for the General Accepting Accounting Principles, which provide a framework for a financial reporting. These principles ensures consistency, reliability, comparability of the financial statements across the organization. Understanding GAAP is essential for accounts, auditors, and financial analysis. Historical background. The original of GAAP can be tracked back to early 20th century in the United States. The establishment of the Securities and Exchange Commission in 1934 played a significant role in the development of the GAAP. The Financial Accounting Standard Board is primary body responsible for setting SAP standards today. Importance of GAAP. GAAP helps maintain transparency in financial reporting, fostering trust among the stakeholders. Adhering to the gap reduces the risk of the mispresentation of the company's financial condition. Compliance with the gap is often required for publicly traded companies and is crucial for attracting investors. Business entity, monetary unit, time period, matching principle, historical task, going concern principle, full disclosure principle, revenue recognition principle, and masterity principle and conversation. Fundamental principles of GAAP. The main principles of the GAAP includes the economic entity assumptions, monetary unit assumptions, and time period assumptions. These principles provide a foundation for how financial transactions should be recorded and reported. Understanding these fundamental principles is critical for accurate financial analysis. The revenue recognition principles. The revenue recognition principles dedicated that the revenue should be recognized when it is earned and realizable. The principle ensures that income is reported in the correct accounting period. It prevents companies from inflating earnings by recognizing revenue and prematurely. Reconciliation principle. The matching principle requires that expenses may be matched with the revenues they help to generate. This principle ensures the financial statements accurately reflects a company profitability during the specific period. By adhering to the principal, organization can provide a clear picture to their financial performances. Matching principles. The cost principles. The cost principle states that the assets and should be recorded their historical cost at the time of the acquisition. The principles provided to the eligibility of the verifiability financial reporting. It prevents the objectives of the valuations that could be mislead stakeholders about a company financial status. The conversation principle. The conversation principles advises the accounts to choose solutions that minimize the overstatements of income or assets. The principles helps to ensure the potential losses are recognized promptly, while gains are only recognized when they are realized. By adopting a conversation approach, organization can be protect themselves against the further certification. Conversation of the accounting. The consistency principle. The consistency principle's requirement that the business use the same accounting methods from period to period. This principle changes to the comfortability of changes statements over a time. If a company changes its accounting methods, it must be disclose the changes and their effects. What is the consistency principles in accounting? The full disclosure principles, the full principles disclosures mandates to reveal the information disclosed in the financial statement. The principle ensures that the stakeholders have access to the necessary information to make firm decision. Transparency is a key in maintaining stakeholders' trust and preventing legal precautions. GAAP versus IFRS. GAAP is primarily used in the United States while the International Financial Reporting Standards are used globally. There are key differences between the GAAP and FIRS, especially in areas like revenue recognition and the assets valuation. Understanding these differences is crucial for the companies operating intermediary or the seeking foreign investments. GAAP compliance. Compliance must be ensure the compliance with the GAAP to avoid the legal penalties and maintain the investors' confidence. Regular audits by the external auditors helps verify the organization adhere to the GAAP standards. Failure to the complete the results in the significant financial and the reputation's damage. Updates the chance. GAP is not the strategic and the subject to the updates chance. The FSSC regularly issues the new standards and updates the exposing once addressing changing business environments. Staying current with the GATS updates is the essential for the accounting profession to the ensure compliance. Future of GAP. The future of GAP may involve further alignments with the IFRS to facilitate global business operations. Technical advancements such as artificial intelligence and blockchain and may influence how the GAP is applied. Continuous education and adoption will be critical for the accountability in navigating future charges. Conclusion. GAP is the essential for the maintaining the integrity of the financial reporting in the business environment. Understanding and applying GAP principles can be lead to more information decision stakeholders. As financial landscape evolve, adhere to GAP will remain adhere to a consistent ethical accounting practice. Thank you.